Hi there, welcome to lecture 2 out of 3 that we've been doing on Wednesdays for Pear Tree. These lectures are a function of a survey that went out to users saying, what would you like to have? 3 vignettes have been done, which is on the Pear Tree website on international giving. You're right, Stephen, it is 3 of 4. The first one was AMT, right? You're right. First one was on AMT, so here we're 3 of 4. We have one next week on giving of private company shares. We did one last week on charitable trusts and marketable securities. This week we're going to talk about insurance, and also at the end, I hope there'll be enough time. I'm going to add 2 other ideas, nothing to do with insurance, one to do with using a loan as a gift planning tool, and also doing something called the reverse trust, which is a testamentary gift, which I think it can be better in the circumstances than a charitable trust for sure, and puts things, reverses thinking a little bit. So we're going to get to that here. So now we're going to talk about insurance, and this is not an easy presentation. We always get insurance presentations for charity. It's always there. It is, and we get these spreadsheets with 12 columns on them and all kinds of things, and it's usually quite complex, and people who are involved in the industry, I don't understand why people aren't buying them for charity and everything else like that. And the reason, I believe, after 30 years, 29 years in the industry, and starting with very much having insurance as part of the gift planning handbook and the ideas and everything, is that we're still treating, and this is the theme of all the lectures, we're still treating these things as products, as gift planning products, and not part of a plan. So it's like, buy an insurance policy. No, it's like, what is your gift plan? The insurance can be a tool in arriving at your plan. So it's not that we're buying an insurance policy. It's that we're doing a plan which makes sense, and the tool within can be an insurance policy or a trust or a marketable security or whatever. So it comes back to gift planning and really working with a donor as to the best way to achieve charitable goals for the institution, for the donor, and then later saying, okay, what are the different options of doing it? And this is an option insurance, not the product. Okay, so let's move to the slide. Okay, so the traditional thought process of an insurance policy is leaving a larger gift. Okay, instead of giving $20,000 to the institution, give $20,000 of insurance premiums, which will create a $100,000 gift. Okay, and that's valid. Or to replace the gift capital for family, I'm giving $100,000 to an institution. How do I want to replace that asset, the $100,000 for my family? Okay, I'll take out an insurance policy, not for the institution, but for my family. So it's part of the gift plan. I'm giving, but I'm replacing, and it's part of the gift plan. And traditionally, the charity is the owner and beneficiary of again, not the one done for family, but a charity. Here's $20,000 premiums, buy a policy. It's a charity which is the owner and beneficiary, and the donor donates the premiums to the charity, who then pays the premiums. So that's traditional and what's there. So let's move forward, and just as an example of a replacing asset type of thing, and this is just a tax mechanism, right? If someone's got a RIF and says, I want to donate my RIF to a charity, and it's $300,000 to it on death, okay, there'll be $300,000 there, and I'm donating a RIF. So, one can say, what happens if I take out a life insurance policy, again, not for the charity, for the estate, of $300,000? So what is this all about? If there's no gift made and the RIF, at death gets cashed, of course, the $300,000 is taxable on the final tax return. Let's assume top tax bracket of 50%. So that means that the RIF asset will be $300,000 less the tax on it, $150,000. So we're left with $150,000 to the family. Okay, that's good. If we do the plan of saying we're giving the $300,000 to the charity, and we're taking out an insurance policy of $300,000 for the estate, what happens? So on the final tax return, the $300,000 RIF is still taxable on the return, but the $300,000 donation receipt is applied against it. So there's no tax on the RIF effectively. The family receives $300,000 of insurance proceeds and says, "Oh, and that's tax free," and that comes in, and they have $300,000. So it seems much better. You're giving $300,000. Before, you would have had $150,000 without the gift, and now you're getting $300,000. But there's a cost of the premiums. So if the premiums for that $300,000 policy were $75,000, okay, so you're saying, well, the family's poorer by 75, but they're getting 300,000, so they're up. They're getting a net 225. We're not looking at the time value of money, which is a consideration, but we're talking generally, and saying, well, this has really worked out. The charity has $300,000. The family, instead of having 150,000, is maybe on a net basis 225. Maybe with the time value of money, it's back to 150 of value. So the family is really doing just as well, but there's been a nice gift. So that's some of the thinking that's there. And if we go to the next slide, what we've had, more lately, and it's been an evolution for 2 decades really, is that we've seen new policies that agents are showing us where the let's say a corporation owns a policy and it borrows from the bank to pay the premiums and the interest on the policy, and then at death there'll be insurance proceeds. They'll pay off the loan, and there's still a balance left from the insurance proceeds to make a gift. So these policies, and again, it's gone through evolution, are available. So are they good? Yeah, they are good. The issue with them, though, is that it's complex and it requires a long-term analysis. In other words, interest expense and things that will be around 20 years from now. So I have found in dealing with donors now for like I say, for a number of decades, is that these complex insurance policies are possible for them for their own uses. When they deal with charity, they don't want to make their holdings that complex, which requires long-term thinking and everything for the sake of charity. It just hit me a number of years ago why people weren't for charity doing some of these things. And I remember one donor who asked me to look at this for them, and I thought, it was to do charity, but it was for their personal use, and they did it right. But they wouldn't do it for charity type of thing. They were doing it for their personal use and their own estate planning and everything, and that type of stuff. So I think that's where I want to bring back the concept of insurance for charitable sake. It's part of a process, not a product. I don't talk about this type of policy. I talk about simple policies that are easy to explain not for them to buy, but at least for them to get the concept of the process of the gift plan. And then it's up to them and their insurance people to find the best policy for them. So as an example of this kind of analysis, let's look at the next slide. And this is what I would call a bread and butter for me explanation, not to sell, but to show the effect of insurance and charity for an estate gift. And I've been using these slides for 25 years. And in fact, the slides haven't changed, and you're going to see some discrepancies in the slides. As I put here tax savings, as you can see, 500,000 on the slide. It was really 480 back then, because the top tax bracket was 48%, not today. It's in Quebec it's 53% where I am. And you'll see later in the slides I'm still using $480,000. It's just my old slides, and this was real people, and I can think of them whenever I show the slides. But this just shows the power of making an estate gift with insurance if you have a corporation, and many people do. And so this is part of sitting and educating people about giving and going through this. It's not necessarily that they're going to say, let's do this, but it's a conversation starter, and as we'll see. So the question that often you give, and when I'm talking to a donor, I'm not saying, oh, when I talk to other people and I talk to the donor, I'm not asking them the question. When I talk to other people, I ask them, would you give a nice a gift on death to the charity? And the answer that they say, again, I'm talking to the donor, that they say is, I'd love to. I love the institution. It's so important, but I want to make sure that my children get most of my estate. So yeah, I'm prepared to do something, but I want my children to get the preponderance of my estate, and that's a norm. Okay, and so so then talking to the prospective donor, then I ask them, so I guess what you're saying is, if it can be done without really affecting your children very much, then you'd be interested. Yes, certainly I'd be interested in making a major gift if it doesn't affect my children very much. Okay. So that's the start of the education, is to talk about, motivations and what your needs are. And in this case is, I'd love to make a big gift, and I don't want it to impinge on my giving to my children, my request to the children. Okay. So here's Mr. A. It could be Mr. and Mrs. A. Has a company, and this is companies. Okay. And that's where the wealth is, right? That's next week's seminar on gifting of private company shares. That's where the wealth is in Canada. That's where it is. And so what Mr. A does is, in a company, he takes out $1 million life insurance policy. Okay. And at the same time, takes his will, and if it's Mr. and Mrs. A, last to die, says, I'm going to give $1 million to the charity in the will. Okay. And what happens here? So at death, Mr. A, at the second death, has a disposition of a company, which is normal, deemed disposition. And if the company is worth $10 million or $5 million, there's a capital gain there. If it $4 million, a taxable capital gain at 50% of $4 million, and that will be on the final tax return, and we pay our tax there. $4 million, we'll pay $2 million of tax, and that's okay. Okay. So here we're saying we want to reduce the tax on death. Okay. And we know that a will gift does it. So here we have, in your will, it says I'm giving $1 million to the charity. So we know that at the final tax return, the taxable income of $1 million will be reduced by $1 million. The taxable income is $4 or $5 million, but we're looking at $1 million. Okay, so $1 million of that taxable income will be sheltered from tax by the will gift of $1 million, and that means instead of paying tax on that $1 million of $500,000, you're not paying tax. So right now we're in good shape. We say, well, but where does the gift come from? I don't want it to come from my family. Well, no, no, no. The life insurance, okay, at death, of course, it's the same time when we read your will, the insurance is going to be coming into the company, to a company, tax free, and a company can distribute it to the $1 million tax free out of the company to the estate, so that the liquidators, can deal with the trustees can deal with the estate. So there's sort of a new $1 million coming into the estate, and that's what you're making, the gift with. You won't really use $1 million, but that's what you're using it for. So effectively, when you were looking at the children getting the estate of $10 million, and they were getting, $3.3 million each, well, all of a sudden there's $1 million coming in, and so there's an extra $1 million in the estate, and that's making the gift. So you're really not affecting the children's values, type of thing. So everything looks good. Oh, hold on a second. Life insurance costs money. So everything's good. Here I'm giving $1 million. That's great for the institution. And the estate's getting $1 million tax free. That's good. But life insurance costs money. Okay. So we can go to the next slide and even go to the next slide. Okay. So here's a little again, done 27 years ago. That really analyzes this from a financial point of view. And I'll come back to the Excel spreadsheet in a second on here. And this just shows someone that in a financial analysis. So the top part says, what were the estate savings? Again, back then it was $480,000. What's their mortality? And again, these numbers are out of whack now. The mortality is different. Insurance premiums are very different costs, but just follow the math. So the first thing is, what's good here? What's good is that there's $480,000 of tax saving somewhere in the future. Mortality table says 12 years. Let's just use that. And interest rate, we're using is 4.5%. This slide from 25 years ago was 4.5%. It's come back into use now. It's back at 4.5%, or even maybe a little higher. So 4.5%. And that says that in today's dollars, the value of that estate saving is $283,000. That means in today's dollars, we're saving the family $283,000 by this plan. What's the cost? You've got to pay premiums. And remember, it's a company paying the premiums. That's going to affect our numbers next slide, but we'll get there. So a company in this situation was paying $37,200 a year on the $1 million policy. Premiums today are much more. And mortality is 12 years. So we put it on the Excel spreadsheet, 37,200. We're doing the present value at 4.5%, that column to the right. So each one is present value to today. And we're saying is that in today's dollars, a company has a cost of $354,000. So the positive side is the family is up $283,000, and the negative side is the company in today's dollars is down $354,000. Now, not saying there's a $70,000 cost here. Well, that's not bad to create $1 million of policy, but let's go further. Let's go to the next slide. Okay, so I've sort of talked about it's a company versus the individual who's making the tax saving. So when you pay premiums out of a company or do anything out of and reduce the value of the company, that's a cost. There's a saving there because ultimately you're going to pay tax on that company, right? If the company is worth $354,000 less in today's dollars and you're passing away, that means when you're deemed to dispose of that company for the final tax return, it's worth $354,000 less. Therefore, you'll have a capital gain less of $354,000, a taxable capital gain of half of $354,000, $177,000 or whatever. And then, of course, you're not going to pay tax on the $177,000, $88,000, or whatever the number is, by virtue of the fact that the company is less valuable. Okay. So there's a saving of $88,000. Now, if you were to say what's the present, and we're looking at present value numbers here. Okay. If this were to happen today. So all of a sudden, the numbers change. So the second line here, with no life insurance purchase, the corporation would have $354,000 more. The estate would pay at that rate 24% on that, half the capital gains, right? Okay, leaving the estate with $269,000. So the cost of the $354,000 present value of life insurance to the estate is $269,000. Now, we then said that what's the value of the tax savings in today's dollars is $283,000. So the net cost of creating $1 million of charity is a saving of $13,637. So we've shown that by doing this, the family is better off. Okay. Next slide. So the next slide sort of says, this is an illusion. There are too many assumptions. Okay. Oh, do you make 13? You don't make $13,000 on this. This is just illusion. That's why you can get caught up in these numbers and spreadsheets and everything. The objective of showing this to somebody is not to say that they're going to make money because there's assumptions and the assumptions can go this way and that way. It's to say, is there comfort here? You said someone would say, I'd be prepared to make the $1 million gift to the hospital, to the school, to the United Way. I'm prepared to do that, but I don't want it to affect my estate very much. And here we're showing you a mechanism that maybe it does affect the estate. Maybe it's not a gain of $13,000. Maybe it's a cost of $50,000 in present value dollars type of thing of doing this. Are you comfortable with that? So instead of your 3 children on a $10 million estate getting $3,333,000 each, they're getting less $16,667. Again, it's like Boolean algebra. Who can understand numbers at a certain point? They have no meaning. Okay, the estate's going to grow. The estate's going to whatever. It's to get that comfort feeling of saying going into something like this is not going to impinge on your estate in any dramatic manner, and your children are not going to be affected really, because if they get $16,000 less, it means nothing, and it does. And that's the point of this, is to get comfort level. By the way, the kicker always at the end is that, we said a will gift of $1 million, and the $1 million goes into the estate, and the estate pays $1 million to the charity. It doesn't do that. It looks at the best way of making the $1 million gift. And if the individual passing away had appreciated securities, which they'll pay tax on, deemed to dispose of them at death, hold off. We're going to give $1 million to the hospital. Let's find those appreciated securities and give it, because it's the same receipt of $1 million, but the appreciated securities, the gain on them, zero. So on our final tax return, we won't have to pay tax that we would otherwise pay. So another saving is part of the plan, really. And therefore, historically, when we've actually done the numbers and we've shown most of the time there's a cost, and the 13,000 is not real. There's a cost of 20,000, 40,000, 60,000, 70,000. If there are marketable securities in the offing of people who've had long-term holds, and you say, okay, you put in those numbers into the play, and you actually bring it down to no cost. Now, it's still not no cost. You can live longer than the mortality. The numbers are the numbers. Traditionally, when met with someone on this, again, we're talking about someone else's. Is this interesting? Yeah, I said, you know what? This may not work for you. give me yours, and what's your birthday, and what's Ethel's birthday? I just get some numbers and see how it works. And the other point is, I use term to 100 as a way of being able to do the math. So when we showed the premiums of $13,687, that was from a term to 100 policy, even premiums throughout. We're going to see this later in another aspect of this. Just easy to illustrate. I'm not telling them to buy a term to 100 policy. It's like, if this is interesting for you, speak to your insurance people and look at what the best gift is. It may be that they're going to borrow the premiums from a bank. It means that they're going to do a participating policy. It means that they're going to do a term to 100. I don't know. I don't care. And I don't want to sell one policy over another. It's not my job, not my expertise, and it's not my job. And it's certainly not. All we're doing is presenting and educating. And if we do that, this particular plan is so simple. You're taking out a policy in a company and you're writing a will gift in. That's the complexity of it. The fact that there'll be capital dividend account and there'll be this and there'll be that and there'll be all these type of things, that's for the accountants and everything to work through. It's not for the charity to worry about. It's just simple. Have you considered taking out a policy in your corporation in order to fund a gift in your will? And that's what we're illustrating. And certainly when I've done this with some people, it's interesting that they've chosen higher amounts of policy than they thought they were going to do from the beginning, type of thing. So you're starting at, a $200,000 testamentary gift, and all of a sudden it's going to $500,000 because really not expensive and is really not affecting the estate. So that's a little bit of that. Oh, okay. I know last week I was very bad with the questions because I started to answer the questions at the end of the seminar, and these were questions that were asked. So I just looked at the question and answer thing. I don't see any. I said, okay, I'm going to try to be more on top of it, so I don't see any. So let's look at the next slide. Okay. Okay, so we're going to talk about something that I was pretty hot and heavy on a couple of years ago, and like a new gift plan. And it was arising not because it's a new gift plan, but because the market was creating the possibilities. And this is gift of an existing policy. Okay. So there's a question here from Stephen about interest expense within a bank borrowings. So when you see those kind of policies, and I'm not going through them, is that there's the borrowings are then used to buy marketable securities, and so therefore the interest is deductible and may not be deductible. So, but in the bank, so Stephen's question says, oh, I've talked about having interest expense with a bank loan and things like that. It's usually structured so that you are paying the premiums with your assets, but you're borrowing and then buying marketable securities with that. So that's how it's structured. That's always a question of tax and GAR, but it generally works. So interest is not deductible if you're borrowing to pay a premium, if that's what you're borrowing for. Insurance premiums are not deductible in the company unless the bank requires, the financial institution requires the bank loan as part of your coverage to repay the bank the money. So oftentimes a company's borrowing from a bank, and they say, okay, you got to pay us so much interest, you got to put up so much security, and we require that you get an insurance policy so that if something happens to you and then the company goes flat, there's money to repay the loan. If you're buying a policy or getting a policy for financing reasons, then the premiums can be deductible, and interest paid to pay the premiums then for it can be deductible. Again, that's why it gets so convoluted when these things are put in front of a donor for to make a donation, and it gets impossible. Therefore, I don't deal with this. But yes, the insurance person deals with them on what's the best policy for you that fits in with your assets, without, and not my job. Okay. Here we're talking now. Thank you, Stephen, for that question. Good question. So usually there's no, so here we're talking about a gift of existing policy. So I've noticed starting about 5 years ago, and maybe more, because I guess the COVID years we don't count, so it's probably longer than that, that there was something new happening. And I was getting calls from insurance people saying, Bobby, I have this policy that this person wants to give up. He doesn't want it anymore. Would you take it? Would you take it? Okay. So sure, I take a policy. It's a gift. It's worth something and everything like that. Of course, the person didn't want to continue paying the premiums. That's why he or she is saying, you know, I'm at a stage in life. I have a policy. I may have purchased it 25 years ago, key person insurance or whatever the reason was. And time has passed, and, you know, and that company, the business no longer exists. And the reason for having the insurance, well, maybe I had a younger family at that time, and all, you know, so I get insurance for the normal reasons of in case. And now it's years later, and, you know, my family's got, they're off on their own and they're okay. There's no issue there. And, oh, I got it for business crisscross insurance. Oh, that business is no longer there, and I'm living, and you know what? I'm paying $25,000 a year of premiums, and I'm at the stage in life where that $25,000 is important to me, and for my standard of life, and I want to give up the policy. And the insurance people say, "Oh, don't do that. It's got value, that policy. So let's go to the charity and see, maybe they'll take it and continue to pay the premiums." Okay, so if they're saying, "Oh, I want to donate it to you and continue to pay the premiums," well, that's good. That's better than starting a new policy with them and paying the premiums. Here, you've already got a policy that's got value coming into your books, and premiums, you know, are payable. Okay, they're paying for it. They're giving you the money, and you'll give them a donation receipt. So, do you take this policy? Okay, so let's go to the next slide. And we'll look at an example. This is, you know, put into our handbook here at the foundation, the Just Community Foundation. We have a whole case study of gift planning in the handbook. And this example was done from a family. And Steve is age 73. He's got a term to 100 policy. It's $500,000 policy. He's paying $10,000 a year premiums. He doesn't have children. Ooh, last week's seminar, Chaturmania Trust. Oh, okay. He's earning $90,000 of pension income and $20,000 of investment income, and so he's okay, but doesn't want to continue to pay the $10,000. Why should he? He's saying, you know, what benefit? You know, I'm paying $10,000 instead of, you know, $10,000. I can spend another 2 months in Florida. I'm just making this up, obviously. And so what am I giving up? When I pass away, money will come into the estate. Big deal. Okay. So his mortality is 17 years according to the charts. Okay. 73, 17 years. Mortality is he'll die at 90. He won't die at 90. He'll die at 88, 104, something else. But the charts say 17 years. Let's go to the next slide. So now we're trying to evaluate what the should we take this policy as a charity? And so we value the policy. Now, do you remember that 5 minutes ago, 10 minutes ago, that chart with the that showed the premiums and the things like that? That can be used to unofficially value a policy, because you have the top part says the value, the tax savings, but you can put in not tax savings, but $500,000 there and say, what's the present value of that? Okay. The present value of that is X dollars. And then the negative is paying out those premiums. And what's the present value of that? So if the charity is going to get this gift, it's saying, what's the value of this policy to us? Well, the present value of the $500,000 policy is X dollars, and the premium paid out is a negative. That's what's there. And the difference is the value. And that tells us what to do. So let's go to the next slide, please. Okay. So let's look at the positive side. So $500,000 present value to today, 17 years at 4.5%. Now, how do you do that? Right? I showed it last week. You can do it on the calculator. 500,000 divided by 1.045 is equal to, and then do that 17 times, equal 17 times. It's going to get to $236,588. Okay. Then, okay, I'm going to do a calculation of $10,000 a year present value at for 17 years. And what's the present value of all those payments? Again, calculations, it's 122,000. So we're saying positively is 236, negatively is 122. The value of the policy is $114,000. Now, if you're going to take this gift and you need a valuation to do it, an actuary will do the valuation. But we've seen that just a simple calculation actually gets quite close to the value, because it's money, it's numerical, it's financial. Okay. So this says to us that we're receiving a gift of $114,000. We're going to pay out premiums, which is negative, but we're going to, get a lot more than $114,000. We're going to get $500,000. So this tells us that we're getting a gift worth $114,000, 261. If that's the value, that's the premium given, and we're somehow positive about this. Okay, so let's go back to that chart that we saw before. That calculation can be done on the chart. No, stay. No, don't go back to it. Don't go back to it. Okay. So that go to the next slide. Okay. That is an Excel program. If any of you want that program, it's not going to have words like that to use for yourself. Just the questions to ask Bobby to pair treat everything. Just send an email. Say, please, can I have an Excel spreadsheet type of thing of this, and it'll, and you've got to learn to use it. You've got to learn to put in, it's going to have a formula in there for present value. I'll answer the question in a second, Joel. You're going to, learn to put in the formula. Oh, the interest rate is 4.5% or it's 5%. You'll learn to put in the mortality. You'll learn to put in 17 years of premiums. It's just how to do Excel, but you'll have that. So if you are interested in that, which will be a value when you're showing that the insurance to the corporation deal, again, some different numbers in there, or just to value a policy and give you an idea of it, someone, Dennis is saying, please send me the Excel spreadsheet. Don't do it that way. Send an email in. So we have that, and we have your email to respond to it, and then Petri will send me the email. We'll forward the email to me, and I'll send it to you. So that's how to do it. Okay, and you'll have it and play with it, type of thing. So okay, now we're back to this example, and we're saying it's $114,000 of value. So do we do it? Now, if we were an insurance company, absolutely, this is clearly a benefit. But because we're a charity, okay, we're not an insurance company. And why is an insurance company different? An insurance company has 10,000 clients or 1 million clients, 10,000 clients, so that mortality works one way or another. it could go against them or for them, but on average, it'll go, mortality is just a factor. Okay. On average, they'll do okay because they're on 1,000 policy. But when you're dealing with one policy, there's no average. It's when is this person going to pass away? And if they pass away, in this example, he's 73, 17-year mortality at 90. Well, if he passes away at 84, you have more benefit, right? Because you're getting the $500,000 not at age 90, at age 84, 6 years earlier, and you're not paying 6 years of premiums. So that's putting more value. But what if he passes away at 96, which is very possible today? People are passing away, deeper and deeper. It's great. And so then you're paying out 6 more years of premiums, and your benefit, $500,000, is coming 6 years later. So what does a charity do? So let's look at the next slide. Okay. And then we'll come back to the slide again. So I'm going to say test it to 100. What does that mean? Assume mortality is when he turns 100. It's a term to 100 policy. Okay. So that means his mortality is 27 years. It's not according to the chart, but I'm assuming, not the worst case scenario, but that's, if he lives the worst case scenario, the son of a bitch lives till 100, right? I'm assuming that. What is the number on that? Well, in that case, 27 years, the value of the death proceeds of $500,000 goes down to $152,000. And the premium cost is now no longer 122, is up to 161,000. So it's negative $9,000. So on a present value basis, taking in a gift of this policy is negative. So now it's not horribly negative, so you have a decision to make. But I wouldn't take it myself. However, I have a relationship now with, Joe, age 73, right? Steve, age 73. He's got no children. He's doing all these things. Let's have a relationship. I could do pretty well with him by doing something really good for him. Is this good for him? He's going to get, in our example, let's go back to the slide before. Okay. He's going to get again, the actuary will do it, and maybe the answer is 116,000, but the value of 114, Steve's quite, that's his receipt. And there's really an anomaly in the Income Tax Act. He's disposing of his policy. If you dispose of an asset, a security or an asset to a charity, you're deemed to dispose of it, and there's often income attached to it, unless you have an exemption for marketable securities. But here with life insurance, how you're taxed on a disposition, not on death. Death, it's the proceeds are free, but before death is a little convoluted. And most of the time, when you give a policy like this, there's no income inclusion. So you have no income inclusion, and you get a receipt of $114,000. Steve will save $57,000 of tax, and maybe not all in 1 year. Maybe he spreads it out over a few years, type of thing. That's a gift to him because he was going to give up the policy, right? Gone, period. I don't want to pay the $10,000. Here, he's getting a receipt of $114,000, saving $57,000 of tax. That's an outright gift to him. So would I do this -9? Maybe, maybe not. But if I have a relationship with him and I go into it with him and I say, this is our situations, could you consider from your estate after it's done, making a gift, to us, and probably he doesn't need the receipt in now because he's going to have the life insurance receipt, but maybe when he's 76 to go to him and say, let's start doing charitable your trust for that gift, because that gives you more tax savings today at no effective cost to it. And then you have a relationship and you can do more. Again, isn't that the back end of what we're all talking about? It's not, the techniques help you. It's a tool, but it's relationship, helping the donor, doing what's best for the donor so that you benefit at the end of the day. Okay. Now, in this slide here, I put in some extra numbers here. And this is discomforting a little bit. When I was showing this 2 years ago, and I think I did show this on the Pear Tree seminars 2 years ago, what were interest rates 2 years ago? 2%, 2.5%, 3%. So doing these same calculations with Steve at age 17 mortality, and said, what is the positive benefit of a $500,000 policy in today's dollars? Well, it's $236,000 at 4.5%. At 2%, it's $357,000. It's a lot more. It's $120,000 more. Now, the $10,000 a year present value, again, at 4.5%, that part is less, 122 to 145, but that's only a $22,000 difference. So back a few years ago, when you were looking at the value of this, it was 357 less 145. It was $211,000, the value of this policy at 2%, if that was the right interest rate. Okay. And now it's $114,000 since I'm using 4.5%. That's the effective interest rates. And that affects our Charter Manger trust calculations, our insurance calculations. So 2 years ago, I was much more hot and heavy on this because the results were better. You looked at it and you did your calculations and your safety things and all this kind of stuff, so that when you did your 27-year test on mortality at a 3% interest rate, you were still positive. Okay, 2 years ago, the same example. If you were using 3% interest rates, your first example, your value was higher, and when you did 27 years of safety, you were positive. So, and I just realized this preparing the seminar, doing the numbers and saying, "Oh, this is looking as good. Why is it looking good? Oh, of course, the interest rates are higher." And what's the effect? So I did the comparison. So when you teach, you learn. And so I think I'll be less positive about this particular gift. It's still there, but there'll probably be fewer policies to take in now because interest rates are a harder factor for us, and that's an effect. So, so that's that. So I'm less positive about this because I see in the marketplace when the policies that have been put in our face recently, our team is watching, there's been more of, no, it doesn't work type of thing. And I think the obvious answer is because interest rates are different as a first thing. And so that's there. But I do believe this is a valid policy. And again, not a valid policy, a valid gift plan. But again, it's part of your relationship. If a charity is talking to someone about making a legacy gift, of ways of doing it, you don't have to go in and say, buy an insurance policy. You have to say, there are different ways of doing this, okay, which may be advantageous to you or not. Oh, you don't have children. Let's look at Charter Manger Trust. You do have children, and you've got let's look at a corporate policy. Let's just look at different ideas here. Do you have an existing policy that you don't want, that you don't need anymore? Are you looking at that? Do you have that? Oh, I do. Yeah, I have this policy. I'm paying premiums. I really don't want it anymore, type of thing. Oh, let's look at it to see if it's a viable gift. Maybe it's not. Okay. So it's not about coming and saying, I have an idea, give me your policy. It's relationship talking, having in your arrows, in your quiver, all these different arrows of possibilities. and then in conversation, in discussion, pulling out the right arrow at that right time because you've had a conversation, you've had a relationship. And then when you show these things, the relationship deepens. Even if they don't buy into it, they show you're trying to work for them. You're trying to show what's good for them. You're trying to, and then saying it doesn't work for you. Trust is built up, not just, oh, buy this thing, buy this thing. It's like, here's the analysis. It doesn't work. It's not so good for you. Okay. And that's a trust factor, okay, of all that. So insurance is a value, not when you're saying, buy this. It's, let's look at what you want to accomplish. Legacy gift, non-legacy gift. Let's look at this. Oh, there are different ways of looking at this. Let's look at some of the different ways. Let's educate ourselves. Okay. So, next slide. So you see there, that's where I put in the email address to Peartree, askbobby@peartreecanada.com, and saying, okay, send an email. That's where you ask questions, but also say, please send me Excel spreadsheet. I'm just gonna, whatever, like an old one I have on my computer, just whatever. It may have someone's first name in it or something like that, and then they'll send me that. I'll forward to you. Okay, next slide. So there's been Canada Life policy. Okay, so there's been some very positive news that have come out from Canada Life, and this happened a few months ago, or maybe more. Again, COVID, we don't know time anymore. Where they've come out and said, we have a single premium policy for charities. Okay, so what's this whole deal about? Policies can have, in buying a policy, you could have policies, premiums that are paid out to 100, like term to 100 and even ones. You could pay out every 5 years, this is the premium, but then the next 5 years, it jumps to another, as you get older, it jumps to another premium level. And then in 5 years later, there's all kinds of different ways. You could buy a policy where, no, I'm only paying the premiums for 5 years. And they'll do the math and they'll say, okay, pay $20,000 a year for 5 years, and you've got your $250,000 policy all paid up. There's all kinds of different styles. At one time, there was single premium policies. So, here's a $250,000 policy. Pay us $50,000 right now. And it's done. And at one time, so you knew what you were doing. And that was called single premium policies, and it had its market. And then the government changed the Tax Act a little bit. And they said, when you're putting up $50,000 all of a sudden, in a sense, you're giving the insurance company your money. They're investing it. They're earning interest income for you, really, to pay the premiums type of thing. So they said, we're going to start taxing you on that. We're going to say you're earning interest income, okay? And you're paying premiums, but you're earning interest income. The insurance company send the insurance owner a T5 slip showing the interest income, and they'll pay tax on it. So, I don't think people like to pay tax. So this was something, what are you doing? There was logic to it, but what are you doing? So, and the rule said, basically, if you're over 5 years of premiums, okay, we're not going to. So if the plan was 5 years or more of doing this, sure, you're paying premiums ahead of time still, instead of paying it to 100, but okay, we're not going to bother with you. So basically what happened is these policies went out of fashion. And okay, 5 year premiums, and we're set out as, call it a minimum type of thing, and we've lost single premiums out there type of thing. So Canada Life came out with a product recently that said it is single premium. They say, but we're back to our old game. But if the owner of the policy is a charity, yes, there's interest income being attributed to the charity, but we don't pay tax. So, okay, good. If the charity's the owner, that interest rule, who cares? Type of thing. So all of a sudden coming back and saying, we have a great product for you charities, single premium policies. Now, a single premium policy is not, it doesn't necessarily make policy right for the person for a gift or anything like that. That alone doesn't do it. It just says it gives you more opportunities or more options. Okay. Now, so what is my feeling about premium? So if you see on the slides, it says, what is this all about? Lifetime premiums, like a charity taking, a policy where there are lifetime premiums every 5 years or something like that. Ich is people apparently. What do you mean by ich? Is it a spelling mistake? No, ich. I don't like it. So my experience has shown is that if someone's got to pay policies for a lifetime, you're chasing them for a lifetime to pay the policy. Obviously, they pass away next year. You're not chasing them, but you've got to the policy charge comes in of $617 to your charity, and you need that $617 from the donor to and you'll give a receipt for it, please, and you're communicating with them. So you're chasing them all their life, and over time, their interests may change. Oh yeah, I set up this policy for you. I don't really care anymore about you. I care about this. 30 years later, I care about someone else, or I've moved, or I've this. So I found them very difficult. These long policies, and certainly those policies where every 5 years, the term policies, but every 5 years the premiums changed. And we had one horrible thing where the man lived to 100, and all of a sudden his every year's 5 years, policy was going up, and the premiums went from $6,000 a year to $11,000 a year to $24,000 a year to $52,000 a year to $75,000 a year, and he was exasperated and saying, look, I can't do this. I'm going to reduce the coverage. Big victory for the insurance company. I'm going to reduce the coverage. So the $1 million policy went down to $500,000 and paid out. And he would talk to the insurance company, hey, give me a break here. They sort of didn't. And at a certain age, he didn't have to pay. He lived to 100. At a certain point in 90, he didn't have to pay because according to the policy. But it was bad. So I don't like lifetime premiums. And so oftentimes if we were doing something, 5-year premiums spread out and just on that. I much prefer the corporate-owned premiums, and that could be lifetime premiums. It's in the corporation. You're paying it as value to them. They're not going away. If they take the will gift out, you can always do that. They're getting value in their company with their life insurance policy. They're not paying the premiums. So I love corporate-owned insurance. So I've always been hesitant about the long-term thing. So this is just so the single premium just says, yeah, it's another way of thinking which gets you the policy done. And then, as you've seen by the vignette on leveraging mining flow-throughs, so certainly we've been in a position here to talk about people paying premiums on life insurance policies, and let's say 5-year premiums, and say, well, every year, how do you pay the premium? You make us a gift of $32,000. And how do you make the gift of $32,000? By a mining flow through, and that so they're the person's creating a $32,000 donation. They may be buying a mining flow through of $75,000. They're in the top tax brackets, and there's no AMT, and they're saying, oh, the cost of the $75,000 after tax and everything But that is so much dollars, $2,000 or something, and you say, okay, I'm making a $32,000 premium payment, and net cost is $2,000. I do that for 5 years, and all of a sudden, my cost of creating the $1 million policy is $10,000, right? Or whatever. So we've really twinned mining flow-throughs with this, and it could be a marketable security gift with a big appreciation. That's also a good gift instead of paying cash for the premiums. Again, you're making a gift to the charity. It doesn't have to be cash to pay the premiums. It could be a gift. It could be a gift of private company shares that get redeemed. It could be marketable securities. It could be a mining flow-through. So that's where, and so when you see the single premium and you say, you know what, maybe I won't do it in the company, the gift. If I can create a single premium, buy a mining flow through, that's a real cheap way of paying the premium, and therefore you have the gift paid up. That may be better than even the mechanism showing with the corporate side of doing, what we showed before. Maybe not, but maybe yes. And so you've got more things. So I think the Canada Life policy allows for discussion. Okay, it's if you can get a quote, and people have told me it's not cheap, the premiums actually, and I don't know what that means from economically, but not cheap premiums for Canada Life. Well, sorry, Canada Life, for saying that, but of getting quotes based on age and then illustrating how things work, I think there's some positive work there. So next slide. So where does this leave us in our discussion? Okay. So my opinion is donors do not want complexity for gifts. So insurance complex things that the charity is there, they'll do it for themselves. My opinion is it's not. And therefore, this business, and we've had it here where the insurance person comes in, oh, let me speak to your board, let me speak to this, and you look at this policy, they're so fantastic. Doesn't work, right? If you've tried it, doesn't work, right? Doesn't work. Okay. Also, I think you can't have someone talking to your donors directly, selling for your place who's on commission. I think that goes against our code of ethics. But okay, so there's a number of things there. Straight is good, like a Canada Life for 5 years. Simple policies is good. Putting it in the company or whatever. Mining flow-throughs can be used against that. I think it's good. Insurance working the other way, where you're protecting the family from the gift type of thing. The insurance goes to the family. We've seen that with the corporate, effectively the corporate insurance. We saw that RRSP plan, where effectively the money is going back to the family, and the gift is the RRSP or other things like that. I think that's good thinking. Estate planning, okay, and we'll be doing that next week with private company gifts. We'll be looking a little bit of that, but where estate planning is part of the insurance package. And so just we're going to show next week a gift of a preferred shares of a company, which dividends are paid out to the charity. And then ultimately the shares are redeemed by virtue of insurance proceeds by the company, not to the charity. Really terrific, So we can use insurance as a tool within the discussion, okay? Not as, buy an insurance policy, but as a tool within the discussion. And so I think that I'm going to look at some questions before going on to the other point. Under what circumstance should we suggest a fair market value in insurance policy? Okay, so the first part of the question, well, when they're ready, when you've determine that it's a good gift for you and you're going to make the gift, you say, and the donor pays for the valuation. You say, yeah, and you're dealing with an insurance person, okay, who's handling the insurance, and you say, okay, we need an actuarial valuation. How big should the death benefit or cash value of the policy be to justify the cost of a fair market value? I'm not looking at cash value. That's cash value is so important. It's not. It's what the death benefit's going to be. And if it's a cash value, it's a different type of policy. It could be a great policy to give, and it has cash value that gives you immediate help, in that you've got cash value to pay the premium, so that makes it easier, type of thing. But how big should the death benefit or cash value be to justify the cost of a fair market value? Look at it from your donor's point of view. If you're seeing that the policy is worth $100,000 and they're going to save $50,000 of tax, so does it justify them paying $1,500 for an actuarial? It's very easy. The actuaries, it's just numbers, right? It's the same numbers that I've shown you, really. And, they can do it very quickly. So does it justify $1,000 cost for them to get $100,000 receipt? It does, but it's their cost. So if the fair market value of the policy is $7,000, you're not bothering with that. You're not bothering with that. It's too, it's not worth it to get involved with that type of thing. Curtis is asking another question: is the charity responsible for the third party valuation of the policy, and how do we find the professional? So I say in all of our situations, the insurance agent, find an actuary type of thing, and we're just there to receive the valuation. Okay. And Curtis, again, who dictates the percentage we use for the present value calculation? The market does it for evaluation. The market does that. So that's why when I'm saying 4.5% now, the market for interest rates is 4.5%, 5% now type of thing. That's there. So it's the market that dictates the percentage. A few years ago, I was using 2.5%, okay, as a calculation. It's the market. Like our Charter Major Trust discussion last week, look at Bank of Canada rates for the period type of thing. That indicates to you what the current interest rate, good market rate is. Tony, why would you need an actuary beyond this? You don't need an actuary only except for the valuation, but you don't need it for beyond, only for valuation purposes. Okay, so I think I've answered the questions on the insurance. So now I promised that we have, I think, 18 minutes left, that I would talk about two policies. We can take the slides off because I don't have slides on this. So the first one is using a loan. Okay, so here's the scenario. Someone comes to you and wants to make a major gift to your charity. Let's say $5 million or $1 million. Let's say $1 million. Okay, and our normal reaction is, thank you so much for the $1 million. You can pay it over 5 years. You can do it over this. Why do we do that? We do it because probably it's been part of the culture to develop that, to pay over time. And probably it was tax effective. Who could use that $1 million receipt all at once? $200,000 a year over 5 years fits in perfectly. Okay. I'm talking about, 25 years ago and things like that. But if the person wants to do a program at the hospital, university, whatever it is, if they're endowing a professorship or whatever, it's, and it's cost $1 million, it costs more today to do it. Well, you can't do that with $200,000 a year. You've got to do it with $1 million. So why shouldn't the person wanting to do something not give $1 million? Okay. And, effectively, yes, if they're doing 200,000, then they're having 800,000 for next year investing and holding on to that money, and then 600,000, things like that. But if they've already said, I don't need the $1 million, I want to give it. Okay. The only problem is the tax wise, doesn't fit in. So we've talked to people who want to do things. And in this case, it's setting up a donor advised fund. But in other cases, it could be at a hospital anywhere really, and saying, I want to give $1 million, but it doesn't pay to make the donation. Yes, I can have a carry forward of the donation. Maybe it'll work, maybe it won't work. So this is the plan. You loan the hospital $1 million, and the $1 million goes in to the endowment, and it's invested, and it's the income goes for the program. Okay. Annually, the donor looks at their corporation and says, let's say the loan's coming from the corporation where the money is. Okay. Could be individual, corporation, same thing. So you look at the corporation, they say, well, looks like we're going to have $300,000 of income this year. And so we could use a donation receipt of $225,000. Okay. And you say, okay, good. And you've got marketable securities in there. So why don't you donate to the hospital $225,000 marketable securities, the best gift, okay, and do that. Oh, okay, but I've loaned you $1 million. Yeah, when we get to 225, we're going to pay back the loan. Oh, look at your personal return. What gift can you use there to bring your taxes down? Oh, I could buy a mining flow through for, and create a $35,000 gift, or I can do marketable securities or whatever, and I can send you another $35,000. Okay, $35,000 comes into the hospital. We would pay the corporation another $35,000. So year in, year out, the accountant and the donor are sort of working. Let's make donations as we need them. Okay, and to save tax, the maximum amount. Oh, I don't want to put myself in AMT. Okay, don't. And as the money comes in, you repay the loan until there's no loan left, type of thing. So it's a way of flipping our thought processes a little bit. And probably for some people, why not do the program? Do the program. It's your program. Do it. $5 million. Do it. Okay. So again, it's how we think, how we work with donors, but that's positive. A way of thinking of things, just you're thinking of something different. You're working with someone and you're excited about the project. What's the best way to give? Well, you can do it this way, marketable securities. You can do this in your situation. You can loan us the proceeds, and then annually you can look at what you need and pay it off that way, type of thing. And it's going things like that. Why shouldn't that be one of the arrows in the quiver, type of thing that you offer people? Some people will say, I don't want to give you the money up front like that. And others will say, okay, why not? It's sitting there. I'm allocating it. I want to use it for your hospital. Let's get the program going. Okay. So that's one idea. Okay. Now I'm going to talk about something called a reverse trust. That's the name of it. I don't know why, but it's a reverse trust. So a charter trust, right, is one where you set up a trust in which the income goes to the donor, the spouse, or whatever. And at the end of the lifetime, the capital goes to charity. And of course, you can give the receipt today for the charter remainder trust. Now, doing a charter remainder trust in your will used to be something that we did. It doesn't give you a receipt anymore because some really a stupid technological, wording of the Income Tax Act was changed. No, it doesn't get you a receipt. Okay. But what we do have is people doing is spouse trusts. Okay. And they create a spouse trust in the will that says, I want my spouse to benefit, to earn income from the trust. And at death, in that trust, it should go to charity, or some of it should go to charity. And of course, we have that problem with spouse trusts, where if you set up your spouse trust to say, here's $1 million, income goes to spouse for life, you encroach on the capital, income can go for his life, and then the capital shall go to the charity. That trust may not get the receipt when the second spouse passes away, because it's a distribution, not charity. And the solutions that have been come up is saying we're setting up a trust, we're giving the trustees the right to make a donation, the right for them to make a donation at their volition. And the person writes to the trustee, says, yeah, I want to give $1 million to the hospital out of this fund, but we're setting this up because then when the second spouse passes away and the trust says, oh, we could use a tax deduction now of $1 million because of the deemed disposition of the property in the trust. And we have the right to make a donation. And in fact, he told us he wanted to do it. Oh, we're making a decision. It's our right. Making $1 million gift, that's a pure gift, and you get the deduction. So that's your way around those rules. But people have these spouse trusts. They've got to relook how they've set that up for charity. Okay. But so let's go back to the spouse trust. Let's go back to the original spouse trust. There's $1 million or there's $5 million in the trust. The spouse gets the income, can encroach on capital for emergencies, and then the balance goes for charity. The reverse trust says, trust is set up. Okay. $5 million is in the trust. It gets invested. Annually, the income from the trust goes to the hospital, the charity. Of course, the charity doesn't pay tax on that. That goes for charitable purposes. Today, you're not waiting until the spouse passes away. Okay. The capital, my intention is that I want to give have my spouse have $150,000 after tax a year to live on. So the trust says, it's in the trust document, $150,000 of capital is distributed to the spouse. The spouse gets the $150,000. There's no tax to pay. It's capital, which has gone there, and the spouse has $150,000. In the trust agreement, it says that the trustees, if there's emergency needs, if there's needs for dollars, if there's something's happened, if inflation takes over, you can actually have the $150,000 payments, inflation, add 2% a year. You can take more money out of the trust and give the capital to the spouse, and this can go on and on and on. Always the income goes to the charity. So you're flipping the part that the income goes to the trust, okay, and to the spouse who pays tax on it. You're flipping that scenario of tax. You're saving tax, which is going to benefit. And in the end, the hospital, the charity can get money up front. Called the reverse trust. You'd have you'd have the trust document there, and it would work, and then paid over time. If more, and usually in the trust, there's more money that's there that's needed for the trust by any situation. So it's always protected that way. In one that our people are working on with someone, in the will, it says, I'm first making a gift to the charity to take away any taxes I have at death. Okay. And the second trust is set up for the spouse type of thing. So you're doing that. And the question is there a deemed disposition of the assets going in the trust? Yes. You're moving assets into the trust that are cash assets and all those kind of things, not laden with capital gains type of thing. So you're doing that with that type of thing, and that's you're not putting in your private company asset that's got you will have a disposition into the trust in that way, because it's not a spouse trust, because a beneficiary during lifetime is a charity, so it's not a spouse trust. For either the reverse trust or the charity, is that a dollar amount value that you can ballpark to justify any of these strategies? No, it's for any amount. The charity remainder trust, it starts with often $50,000. It's not, but you do it every year with the person. It can be 75 going into the trust, 50,000. You have a relationship where every year that person is now putting in more money into a charity remainder trust, and they're coming back and seeing you. So, it's not about quantity; it grows. And reverse trust, again, it's just off someone's will how they want to take care of their spouse and everything. So it's generally a fair amount of money because if you've got $10,000, you're not giving it, worrying about your spouse, your trust getting it. You're just giving it to the trust. That's your $10,000. So it's usually a lot of money in the reverse trust to say, yeah, I want to give him $150,000 a year for the next 30 years. There's usually a lot of money in there. Yeah. Okay. So, okay. Okay, so I think we've come to an end to what's there. It's 11:55. Any other questions on the last few things? What is the amount of the tax receipt in the case of the insurance gift and charity takes over the premiums? It's the value of the policy, which the actuary has done. If Curtis, again, if the present value is very low or negative, would you suggest the donor also donate the premiums each year? Absolutely. So that's why when I showed that example and I saw a negative a long time, I said, okay, it's a no, but maybe it's a yes. Talk to the donor about, maybe donating part of the premiums or maybe giving another estate gift, which will happen. Yeah. So I think that ends our session. So I hope I was at all clear. And none of this is easy, but it's just how you think differently. And next week, I really look forward because I love, as everyone knows, I love to talk about the gift of private company shares. And I look forward to next week. Send in your questions. Send in your, please send me an Excel spreadsheet. And hopefully I'll see you again in TV land next week.